Okay, moving on with accounts receivable, we're going to talk about the valuation of accounts receivable. So, valuations issues related to accounts receivable. So, accounts receivable should get reported at what we refer to as net realizable value. That is the net amount the company expects to realize from the accounts receivable. So, reporting of accounts receivable involves classification and the valuation on the balance sheet. Classification involves determining the length of time entry receivable will be outstanding, and the value for short-term receivables is at net realizable value. We just talked about this idea that, well, in general, we kind of ignore time value of money for especially trade receivables that are short in duration. So that's why we record them at the net realizable value. That's the amount we expect to receive. We aren't discounting that for time value of money concepts. Now, when we get into long-term receivables, then we'll start discounting things. If you have a 5-year note, even if it doesn't have a stated interest rate, that means, well, in today's dollars, that's not worth the amount of the note because of time value of money concepts. But for trade receivables with, I'd say, typical payment terms, we don't have time value of money concepts. They're recorded at net realizable value. Now, that's kind of important to know that accounts receivable are recorded at net realizable value. Now, what does that mean? Well, that means it's the amount we expect to receive the net realizable value. That means we have to figure out, well, what don't we expect to receive? So we have to take into account uncollectible accounts receivable. That means we have all these receivables, but there's a chance a lot of them are not going to actually pay us. So we need to first estimate that, and then when we actually realize they aren't going to pay us, we need to write that amount off. But the estimate is when we record our expense, because the expense is associated with the revenue it generated. Going the whole way back to our expense recognition policies from the conceptual framework. Expenses follow revenue. Now, if I make $100,000 worth of sales this quarter and I expect that $10,000 of these are not going to pay me, that $10,000 is an expense this quarter. I don't wait for a year until I realize, oh wait, now I know who's not going to pay me. It's not an expense in a year, it's an expense today because it helped me generate revenue today. I made these sales knowing that some of these customers were lousy and weren't going to pay me. I just didn't know who it was at the time. And it turns out in a year I'll find that out, but I don't wait to find out to record my expense. Our expense gets recorded today because I've generated the revenue today. So that expense helped me generate revenue today, even though it's an expense that I will not fully understand what it is for another year. So we estimate the amount we're not going to get paid. So we record credit losses as debits to bad debt expense or uncollectible accounts expense, depending on what you want to call things. This is a normal, necessary risk of doing business, and GAAP requires that we use the allowance method. Under the allowance method, we estimate the amount that's not going to get paid, and we record that as an expense in the period of the revenue. Again, GAAP's requiring that we recognize the expense and the revenue together. We don't separate them. Now, how you estimate that can be done in a number of ways as long as it's systematic. GAAP accepts it. The two most common methods are percentage of sales or a percentage of receivables. And I would say even within those two, percentage of receivables is by far the most common. And the idea is at any point in time you have receivables. What percentage of those receivables, usually at the end of the period, are you not going to be able to collect? Well, everything that was, it's done at the end of the period because, well, if you make a sale and you have a receivable and someone pays you before the end of the period, well, you know you collect that amount. So it's only what's at the end of the period that you don't know whether you're going to collect it. So that's typically customers look at their receivables at the end of the period and estimate what percentage of those receivables are they not going to be able to collect. And that's what they record as the allowance for doubtful accounts, is the amount they don't expect to receive on those receivables. So this allowance method for uncollectible accounts involves estimating the uncollectible accounts at the end of each period. It ensures that companies state receivables on the balance sheet at their net realizable value, and companies estimate the uncollectible accounts and the net realizable value using information about past events. This idea that the company has been making sales supposedly for quite a while now, some amount of these sales they know, or some amount of these receivables, they know they're not going to be able to collect. So because of that, they are able to estimate the amount they can't collect. That's how we get to estimate it. If it's totally not estimatable, if the company throws up its hands and says, there's no way for us to know how much we're going to collect? Well, accounting has a solution for that. They say you can't record any revenue until you know that. Guess what? You tell management that, and all of a sudden they're able to estimate how much they can collect. So they estimate that, and that's what they record as an allowance for doubtful accounts. That is a contra account to receivables that gets reported every period. So let's do an illustration. Let's assume that Brown Furniture in 2017, which is its first year of operations, has credit sales of $1.8 million. Of this amount, $150,000 remains uncollected at December 31st. So of all these sales, $150,000 is their accounts receivable at the end of the year. The credit manager estimates that 10,000 of those receivables will be uncollectible. And so the adjusting entry to record the estimated uncollectible accounts, we're assuming a zero balance because this is the first year of operations. Assuming a zero balance, the adjusting entry is to debit bad debt expense. We're recognizing the expense in the period of the sale. So we're recognizing $10,000 of bad debt expense, and then we're putting it as an allowance for doubtful accounts. It's an allowance because at this point it is an estimate. We don't know who's not going to pay us, and we really don't know exactly how much we're not going to get paid. But we do know there will be something. We just don't know who or the exact amount. This is our best estimate, and for the time being, we're just going to stick it in as a contra account. So that's how it gets put forward at the end of the year. It's a contra account, so it reduces the amount of the accounts receivable reported for the period. The gross amount of receivables was $150,000. The allowance was $10,000. So our net receivables was $140,000, and that is what will be reported as receivables in the financial statements for the end of the year for the company. Now, we proceed with this. We're going to actually realize, okay, who's actually not paying us. And when we realize that and are able to say, okay, this customer, they're not going to pay us. This is a bad account. This receivable is uncollectible. So now we need to write off that receivable. That receivable is a specific receivable and it's a specific amount. So we need to get rid of that specific receivable. So when companies have exhausted all means of collecting a past due account and a collection appears impossible, the company should actually write the account off. So when companies determine to do this varies drastically by companies. If you're talking about unsecured debt like credit cards, those typically get written off after 210 days. Once they're past due 210 days, they're written off. It's unsecured. There's nothing they can do. If you have secured credit or something else, they might have different policies. Depending on the company, you're going to have different policies. In general, the longer an accounts receivable is outstanding, the more you're going to put an allowance on it for, which we'll get to in a minute. But at some point, we need to realize, okay, they're not going to pay. And at that point in time, we write the account off. Now, this does not necessarily mean the company has totally given up. A lot of times the company will write it off because they say, we're not going to collect this. They'll write it off. And then they'll take that receivable and they'll give it to a collection agency. And they'll say, whatever, if you can get this money, great. We're assuming nothing. So anything they get is great. And that money might eventually come in which case they would have to reverse it. So don't assume that just because you wrote it off from an accounting standpoint means the company has given up all attempts to get the money. No, it just means that they don't think they're going to. There's a difference. They may still try, unless it costs more to try than it's worth, but they don't think they're going to get anything, so they're going to write it off. So if we have moving on to our example. So the vice president of Brown Furniture authorizes a write-off of $1,000 owed by Randall Company on March 1st. So they're now identifying a specific receivable from Randall Company that is not going to be collected. They need to write this off. So we don't write it off to the expense. We already recorded the expense when we recorded the revenue, right? That expense followed the revenue. But now all we're doing is saying, well, we had an estimate for allowance for doubtful accounts. We didn't know who that applied to. Now we know. So now we're just going to take our estimate and apply it to the specific account. So we're actually going to debit allowance for doubtful accounts. So we're going to reduce our estimate, which is the allowance for doubtful accounts, And we are going to simultaneously reduce the receivable that we expect to not pay us now, the one we are writing off. So we are crediting the accounts receivable, in this case, the account receivable for Randall Company, for $1,000. So that journal entry is a debit to the allowance for doubtful accounts and a credit to accounts receivable, both for $1,000. Now, let's go, jump forward. Let's say Randall actually ends up paying us. Miraculously, they somehow found a bunch of money and decided they wanted to make good on all their old debts. So they pay us. Now, we just have to reverse everything. So we're going to recreate our accounts receivable. We're going to put the allowance back into the allowance account. So that's going to be a debit to accounts receivable, a credit to the allowance for doubtful accounts, and we get to record our collection of the $1,000. So we record debit to cash of $1,000 and a credit to the accounts receivable, which means they're paying the accounts receivable for $1,000. So we reverse our write-off and we record the cash receipt. And that is how that ends up working out. Now, the actual estimation process, that was the mechanics of how it all worked. Now, we have to estimate. This is actually really hard. Estimating the future is kind of difficult. Most people struggle to do it. But companies generally don't do a horrible job of estimating their who's not going to pay. So, we're going to estimate our allowance. Typically, the most common method is a percentage of receivables approach. And this the report, it estimates the receivables based on, or estimates the allowance based on the amount of receivables. So companies can do this by using one composite rate where they just say, okay, well, we estimate that 5% of our receivables at the end of the period are not going to be collected. That's a composite rate. It's one rate, 5%. They apply it to all of their receivables. That is one method. It's not the best method. Typically, if companies don't have a lot of bad debts, they might use that method because it's not going to make any difference if they did something more specific or more granular. The best method is to use what we refer to as an aging schedule. And aging is a list of all their accounts receivable by age. So you list all of your customers. So down, say, the far left-hand side, you would list all of your customers. And then in each column, you would put how much money they owe you based on the due date. So the first column, let's say the first column is current. That means it's not due yet. For instance, if we're selling on 30-day terms, that means it's within 30 days. They haven't paid us, but they don't owe us it yet either. So let's say the first column is current. Hopefully everything is current. That would be awesome. That's not the case pretty much ever. So we take the first column is, say, current. The next column is how much each customer owes that's, say, 30 to 60 days past due or past billing time if we're doing 30-day bills. So the next column is going to be 30 to 60, and then 60 to 90, and then, say, greater than 90 or 90 to 120, and then greater than 120. At some point, you just have to say greater than. Otherwise, you go on forever. But this idea is then by each customer, you can look down your customer list and say, hey, okay, for instance, Western Stainless Steel Corporation has $15,000 that is current. They have $65,000 that is 30 to 60 days old, and they have $18,000 that is 60 to 90 days old. That means it's been 60 to 90 days since we billed them the $18,000 that they have not yet paid. So this aging schedule is very helpful. Management, every company I've interacted with runs an aging schedule. Every accounting software package has an automated aging schedule. If you open up QuickBooks, it has an automated aging schedule. You just hit run aging schedule and it produces this. Banks require it. Management evaluates it for their collection efforts because management has to make sure people pay them. So they use this aging schedule with the idea that, well, if you looked at just a company's current accounts, there's some small percentage of those that won't pay. And that percentage grows as you get to older and older and older accounts. So then by the time you get to an account that's, say, more than 120 days old, so in the example that I'll put up, so there's this Fremont Sheet and Tube Company, there's an account for $55,000 that's over 120 days old. Now, the chance of the company actually collecting that $55,000 is not great. And it's definitely a lot lower than it is for the current amounts that all of our customers owe us in this case. So what we do is we apply a percentage to each of those buckets, or each of the aging buckets. So it's usually a very low percentage that we apply to current accounts receivable, and it's a very high percentage that the company would apply to, say, over 120 days old, which means there's a good chance we aren't actually going to get that. So, and then you just do all those multiplication and basically create a estimate based on the aging and the percentage in each bucket. Now, if the company has done a lot of work, they will have actually done a study to figure out what's the probability that a current account never pays, and what's the probability that a 30 to 60 day account and a 60 to 90 day account, what's the probability historically of those not paying. That's incredibly time consuming for companies to do that. Most of them kind of don't. They just do some rough estimates. And as long as they're reasonable, it's generally fine. It's usually informative. So they run all this, they apply the percentages to the amounts in each aging bucket, and they get the amount that they need to have the allowance for each aging bucket. They add all those up, and you get your total estimate for your allowance for doubtful accounts for the end of the period. In this case, we ran all that with the stated percentages, and we end up with an estimate of our allowance for doubtful accounts of $26,610, just based on this little example we ran right here. Now, what entry would we need to make to record this allowance? Well, that depends on what the balance is in the allowance account. If the allowance account has a zero balance, it's pretty straightforward. We need to record bad debt expense for the period of $26,610 and record an allowance for doubtful accounts of $26,610. That's our entry. That's assuming that the allowance account has a zero balance in it. Once a company starts operations, that's incredibly rare. Usually the company has some balance sitting in their allowance account because it was an estimate a year ago or a quarter ago. It didn't turn out to be exact, so there's either a credit or a debit balance sitting in there. So it doesn't matter what the balance is, we know what the balance has to be. The balance at the end of this period has to be $26,610. The entry is whatever it takes to get the balance to $26,610. So let's assume that the allowance account has a credit balance of $800 before the adjustment. That means it's already has $800. So the normal balance in the allowance account is a credit. There's already a credit of $800 in there. We need to end up with a credit balance of $26,610. So what we need to do is record an entry for bad debt expense of $25,810 and a credit to the allowance of doubtful accounts of $25,810. The $25,810 plus the $800 credit balance that's already in there will give us $26,610, which is the balance we need to have in there at the reporting period. Now, if you have a debit balance, which is possible, it's possible to write off more accounts receivable than you estimated. That would give you a debit balance in your allowance account. In that case, your entry or your expense for the period would have to be more than your estimate to bring that balance from a negative the whole way up to the balance it needs to be for the end of the period. So if we look at another example, Wellington Corporation has outstanding accounts receivable totaling $1,270,000 as of December 31st, and sales on credit for the period of $6,400,000. There's also a debit balance of $6,000 in the allowance for doubtful accounts. It's a debit balance, it needs to be a credit for sure. If the company estimates that 2% of its accounts receivable will be uncollected, what is the entry to record the estimate for uncollectible accounts? Well, we just did this, very similar. Well, we take 2% of our receivables. So our receivables are $1,270,000, okay? And we're estimating that we have 2% of that is going to be uncollectible. So we need to record the entry to bring the $6,000 debit balance up to 2% of $1,270,000. Now, that is going to entail, let's see. So first of all, 2% should be, let's see, is $25,400 is the amount of the allowance that we need. So to get to the $25,400 from a $6,000 debit balance, we need to credit the allowance for $31,400. So our entry is going to be a debit to bad debt expense of $31,400 and a credit to the allowance for doubtful accounts of $31,400. So what will the balance be in the allowance for doubtful accounts after the year-end adjustment to record the bad debt expense? $25,400, exactly what it needs to be, which is 2% of $1.27 million. So let's move on to our next practice problem. So during the year, let's say Kinder Company made an entry to write off $32,000 of an uncollectible account. Remember, the write-off is going to basically be taking it out of the allowance and applying it specifically to an accounts receivable. So if they wrote off $32,000, that was going to be a debit to the allowance account and a credit to the accounts receivable. So they made this entry. Before the entry was made, the balance of the account in accounts receivable was $400,000 and the balance in the allowance account was $36,000. So they had a $36,000 balance in the allowance account. They took 32 of that and applied it to a specific account. So what is the entry to record the write-off? Well, the write-off is a debit to the allowance account. So we want to reduce the allowance account by $32,000 and a credit to the specific accounts receivable that's not paying for $32,000. Now, what's the net realizable value of accounts receivable after the write-off entry? That's kind of a trick question. What was the allowance for doubt? What was the net realizable value of accounts receivable before the write-off entry? Well, before the write-off entry, it was $364,000. It was $400,000 minus $36,000, which is $364,000. That was the net realizable value before the write-off. Now we wrote this off. That it had no effect on the net realizable value. It's still $364,000 because all we did was take some from the allowance and apply it to a specific accounts receivable. The allowance, we already had reduced receivables to their net realizable value. The fact that we wrote one off did not change our estimate of the net realizable value of our receivables. So the net realizable value stays the same when we write off the accounts receivable because we recorded the expense and the allowance when we estimated it initially, which should have been in conjunction with the sale, is when we recognize that expense. So moving on to the valuation of notes receivable. A note receivable, in contrast to an accounts receivable, is supported by a formal promissory note. It is a written promise to pay, as opposed to oral, of a certain sum of money at a specific future date. It's a negotiable instrument, which means it can be traded or exchanged. And it's usually interest bearing. However, you can have zero interest bearing, but that doesn't mean it's not actually zero interest. It means it's zero interest bearing, which means it doesn't have a stated interest rate. But as you should know, time value of money concepts, we just take, if there's no interest payments or no interest stated, that doesn't mean all of a sudden money is worth the same amount now as it is in the future. So just because you don't state an interest rate does not mean time value of money concepts have just suddenly disappeared. So that is a note receivable. These are generated through all kinds of reasons. They can be customers. Sometimes customers want longer terms, in which case the company will give them a note receivable instead of just an accounts receivable. High-risk customers, the company might want something that's like a negotiated instrument instead of just an oral promise to pay. There can be loans to different parties. They can have sales and purchases of equipment. All kinds of things can generate notes receivable. So, notes receivable, if they are short-term, a short-term note receivable, it's treated the same way as an accounts receivable and is recorded at face value less the allowance for doubtful accounts. So if it is a short-term notes receivable, it's treated just like an accounts receivable. It doesn't matter whether it's an oral or a written promise to pay, you're still just going to record it at face value or net realizable value, which is face value minus the allowance or what you don't expect to collect. That's net realizable. So, however, if it is long-term, it's recorded at the present value of expected future cash flows. Okay, there we go. There's our time value of money stuff. The present value of expected future cash flows, that is what we record the value of a note receivable at. So, in line with that, basically everything we did with bonds and bond discounts and premiums and amortizations that we all talked about and had a whole bunch of study on and lectures on regarding the time value of money stuff. All of that, we're just going to bring it all into notes receivable, because all a bond is a long-term note receivable, and all a note receivable is a short-term bond or a shorter-term bond. The accounting is the same regardless. So, for instance, note receivable, if the stated rate on the note is equal to the market rate, then the note is issued at face value. Ta-da! Not a surprise. If the stated rate is greater than the market value, then the note is issued at a premium. And if the stated rate is less than the market value, then the note is issued at a discount, just like for bonds. That doesn't change. Now, the valuation of these is the same as we had for bonds. We take the present value of all future expected cash flows and we discount them back at the prominent interest rate or the market rate of interest, just like we do for a bond. So if there is a principal payment, we need to figure out, well, what is the present value of that future principal payment? And if it's paying interest, say quarterly or annually or whatever, we discount back the annuity payments of interest and come up with a present value of the note, the same way we do for bonds. Because of that, I'm not going to be working through a ton of examples on this. I worked through a lot of them. If you need a refresher, go back and look at the bond amortization lecture from 2 weeks ago. That is the same thing. You can just insert note instead of bond in all of the examples, and you get the exact same thing in terms of how you calculate interest, using tables to figure out the present value of the single sum and the present value of the interest annuity payments, summing those two things together to get the present value of the note. Now, the accounting for that going forward is the same as for the bond. The interest rate is the market rate, not the stated rate, just like it is for bonds. The amount borrowed, or in this case, the amount lent, is going to be the cash that changes hands, or the value of the underlying good that's changing hands. If this is, say, sale of a good and where you receive a note. Now, one thing I will highlight, you can have zero interest bearing notes, just like you have a zero interest bearing bond. We didn't talk a ton about them when we talked about it a couple weeks ago, but you can have a zero interest bearing note. All that means is there's no interest payments. It doesn't mean suddenly the bond is now worth more or less, and suddenly we've thrown out our time value of money concepts. No, quite the contrary. All it means is that there's no annuity payment on this. So if I'm going to receive, if I make a sale, let's say I sell a car and I say, you know what, I'm going to write a zero interest on this car for 5 years, and the amount that you owe me in 5 years is $50,000 on this car. Great. From an accounting standpoint, though, zero interest does not exist. So whatever the market rate of interest is, you need to take that $50,000 that you're going to get in 5 years and discount it back to the present value. That's the actual value of the transaction, of the sales transaction today, is the present value of the $50,000, not the $50,000. Everything from the present value today until you receive the $50,000, that's interest income to you because you're loaning money. That's just because it says zero interest bearing note does not mean there is no interest income from the note to the company. So it's done the same way, except now it's actually a much easier calculation because now there's no annuity payment. It's just a single sum. Well, what's the present value of a single sum in 5 years? And then your interest revenue every period is whatever the market rate of interest times the present times that carrying amount, which the first period is going to be the present value calculated, times the interest rate is the interest expense, or sorry, the interest revenue in this case. And basically you would have set up a bond or a discount. In this, you have a discount on notes receivable. That discount will have reduced the future value to the present value. You amortize away the discount to get to the new carrying amount of the note, which then you calculate interest revenue on that, just like we did for the bonds. We're now just doing it for a note. It's the same process. So I'm not going to go back over that really anymore. So I'll just say, you don't get to forget the time value of money stuff just because we moved on. So with that, in summarizing kind of notes receivable, for short-term notes receivable, accounting requires the company reports it the same way as they would accounts receivable, basically a net realizable value. For long-term, a GAAP requires the companies disclose not only their costs, but also the fair value of the note in the financial statements. That kind of wraps up our discussion of notes receivable. Now, one thing to keep in mind, there is a fair value option. This is relatively newer, where a company can record, they can choose to record their receivables at fair value. Now, fair value is in contrast to net realizable value, which is how they're typically recorded. So a company can do this, so they can take a fair value option. The companies have the option to use the fair value as the basis of measurement in the financial statements. If a company chooses the fair value option, receivables are recorded at the fair value, and unrealized holding gains and losses are part of net income. So if the value of the receivable goes up during the period or down during the period, that changes your net income. And the company has to report the receivable at the fair value each reporting period. Now, if a company does this, companies may elect at the time the instrument is originally recognized, or when some triggering event requires a new basis in it. And they have to continue doing this as long as they hold the instrument. They cannot choose to do fair value option today and then change the net realizable value tomorrow and figure out, well, which way is the wind blowing and that's what we're going to do. No, if they want to do this, they have to choose to do it and stick with it the whole time they have that instrument. That prevents companies from using this as a way of manipulating or managing their income. So with that said, that is an option. Again, any changes in the value of receivables is going to go through net income. And that's why most companies don't actually want this. They just want to have a receivable at net realizable value. When you fair value something, you need to take into account all kinds of other things. For instance, time value of money, for instance, a little bit more about, say, credit risk or duration or something along those lines that may not be automatically in the net realizable value calculations. So especially depending on how you want to do fair valuing of these receivables. So that's a fair value option that I just want to make you aware of, that option in accounting. Next, we are going to talk about disposition of accounts and notes receivable.